Well, we've just finished the annual profit reporting ritual where the market is swamped by companies dutifully tabling their full or half-year results. This year's earnings season also coincided with a period of remarkable turbulence on global markets. So what have we learned this time around? For his assessment, I caught up with UBS's chief equity strategist, David Cassidy. Well, David Cassidy, we saw some record-breaking results this reporting season, in particular from BHP Billiton and Rio Tinto. But overall, how did you think Australian companies fared?
Well, earnings growth overall was quite solid, around about 11% growth for the year. But there was a very stark dichotomy between the resource sector that delivered over 30% earnings growth and the rest of the market, where we saw a fairly anemic 3% growth for FY11.
Well, what do you think were the reasons for those lacklustre results outside of the resources sector?
Well, there's really two related factors there. There's the strength of the currency that we've seen particularly over the last 12 months or so, and there's, I guess, the related issue of very much a two-speed economy, where anything outside the resources and resource-related areas is quite subdued at the moment.
So does it look like it will be a difficult year ahead to achieve any sort of decent earnings growth?
Well, I think those two headwinds are still, very much in place. The currency's still high and looking like it even wants to go higher, and the ex-resources economy is still quite subdued. So yeah, I think it's going to be a pretty tough slog.
Well, one thing that stood out this reporting season was the number of companies announcing job cuts or cost-cutting drives. Do you think that will be a feature of corporate Australia in the year ahead?
I think it's inevitable. I think that corporate Australia is really being positioned for a broad-based boom that really hasn't arrived. I think the reality is that things are very two-tiered and quite subdued outside the resources sector. So I think cost-cutting, restructuring, I think it's just a fact of life for much of the market.
So is there a risk of a feedback loop developing where if companies are cutting their costs, that will slow the economy and make it harder to achieve any earnings growth again in the year ahead?
Yeah, I think it is a bit of a double-edged sword. I think it has to happen, and I think we've seen a lot of this sort of activity in markets and economies like the US, and I think it has been good for profitability, but obviously it does have some feedback loops into the economy in terms of employment in particular. I don't think it's going to be a dramatic story at this stage, and therefore I don't think it's going to have a dramatic depressing effect on the economy. I guess the silver lining may be that it may be enough to induce the RBA to lower interest rates at some point over the next 3 to 6 months, which would be a good thing for activity down the track.
So how do you see valuations at the moment? Do you think the Australian market has been oversold?
Yeah, well, we tend to see valuations as attractive. The overall market is trading under 11 times 1 year forward earnings expectations on a price-earnings ratio basis. That is very attractive based on historical benchmarks. So we think the valuation picture looks attractive. There are risks out there in relation to the US economy, the European banking sector, but on a risk-return basis, we think that the market looks attractive.
Does this mean then that it's a good time to be buying shares, and would you be buying with any great enthusiasm?
I'd certainly be accumulating the market here. I think, as I said, there are risks in relation to the US and Europe, but I think looking at it on a risk-return basis, I think, yeah, it's a good time to be accumulating exposure to the Australian share market, definitely.
And what do you think are the most attractive areas to be investing in right now?
We still have a preference for the mining and resource services areas, so we're still playing that broad resource thematic. I think beyond there, it really comes down to more of a stock picking situation, but there's plenty of good dividend yields on offer in the industrial market. Balance sheets are in good shape, so I think there's plenty of stuff out there that looks good buying at the moment.
Thanks for joining us, David Cassidy.
Thank you.